Alright, so let's start. First bit, some recap. Why are definitions important?
To put it in the right.
To follow the right rule. Do you agree?
Yeah.
Okay, so if I have an account, must I always identify its element?
Yes.
Always. Okay, so how do I determine what an asset is? I need to look for the keyword, which is resource. Okay, and then liability keyword is obligation. Exactly. All right. So if I know it's a resource, it's going to be an asset. If I know it's an obligation, it's going to be a liability. What's special about these two, though? Can you group them in different subcategories?
Yes, you get a current asset and a non-current asset.
Correct.
And then a current liability and a non-current liability.
Good. So long-term and short-term assets and liabilities.
Yes.
Right, then you've got income and expenses. Same thing again. Definitions are key. The reason for the definitions is to identify what I have so I can then apply the correct rule. Assets generally create income. Expenses generally come from liabilities. It's always important to remember where the debits and credits are in terms of their balances. So the pluses are key. Obviously, you would debit the expense and you'd credit the income. Okay. Capital and drawings, you should know what they are. Capital is money or assets contributed by the owner. The key word is owner. So any contribution made by the owner will affect capital, and capital is credited. Drawings is debited because you've got the D for drawings and C for capital. Right, it's basics. We've already looked at these. Okay, so from last week. Right, now we're going to apply this double entry system. So do you agree? Transactions will have two sides, a debit and a credit. You'll have two accounts that will be affected. It can be the same account. So an asset can go up and the asset can go down. Okay, it can have the same effect.
Okay.
Alright, so if I've got a transaction, the first step is to identify what is the transaction, cash or credit. If it's cash, it'll affect which accounts? Bank. Okay, and if it's credit, what account will it affect? Two possibilities. Creditors or
liabilities.
Debtors.
Oh.
Okay, a creditor is a liability. Alright, so you'll either have debtors or creditors. And then earlier we spoke about those two. Debtors arise when you do what?
When I sell something to a client.
Correct. And creditors?
When I buy something from a supplier.
Correct. Okay, so accounting elements are key because you'll need to identify what they are. So creditors we know is a liability. Debtors we know is a asset. Okay, and that's the objective. The objective is to try and understand what you're dealing with. Okay. And then you look at the effect, which is the increase or decrease, which is basically what you did as part of your practice exercises.
Yeah.
Okay, you identifying what they are and what the effect was before you get the debit and credit. Okay, so this you've seen before. We grouped transactions into cash or credit. Here you've got receipts and you've got payments for cash. That's important for a bank recon. You do a bank recon in this module again. So it is something that you are going to have to redo, but it's easy and you can get quite a lot of marks if you know how to do it. Credit, buying and selling. If I buy, I have creditors, and if I sell, I have debtors. Okay, just to put those words on this slide. Okay, so buying or selling on credits. Okay, so let's see if you can still interpret transactions. You've actually done this before. It's a bit of a revision from 1501, but they cover the same thing in 1502. Okay, so this should be okay. So what am I going to do here? We can learn rules or we can apply rules. So we learn 6 rules and we practice applying them instead of remembering all these different scenarios. Okay, the scenario here, the owner gives $1 million to the business. What are you thinking about?
Capital.
Correct. So debit what, credit what?
Capital increase. Capital still increases on the credit side.
And what's the other account?
Bank.
Correct. Okay.
And bank is an asset, so it increases.
Decrease. Well, increase.
Increases.
Correct.
On the
Both increasing.
Yes.
Right. Next one. Loan. Number 2. Company obtains a loan.
Is a creditor.
Loan isn't a creditor. Loan is a loan. Loan is a
Liability.
liability. That's better.
My word.
And what's happening to the liability?
I get confused with when I should write one.
Okay, so
Why?
creditors is when you buy on credit. A loan is when you get money from the bank. Do you agree? Okay, so if you buy from a store and you buy on credit, do you owe the store?
Yes.
Okay, and if you owe the store is your creditor. Do you agree?
Yeah.
If you take out a loan from the bank, you owe the bank, but you can use that cash to buy whatever you want.
Okay.
Okay, so a loan is a loan where you're actually getting cash. A creditor is someone that gives you goods. Okay, so getting a physical item that you've bought. Okay, so you don't write liability, you would write loan, which is the liability. And the liability is being credited. And now what else are you affecting? What happened? You obtained 2 million.
It's bank.
Yes, you're right. Why?
Because bank increases because you got a loan.
Correct.
Yeah.
Okay, so your loan is in the form of cash. Your cash will affect the bank positively. Right, next. What happens here?
Okay, so you're buying an asset, so assets
Yes.
will increase
Why?
because you're buying an asset.
Yes.
So the asset
So,
increase.
yeah, you've got more than you had before, more resources.
Okay. And then bank decreases
Yes. Okay, why?
because you're using money
The check.
from the bank. Yeah.
Correct. Okay, so bank credited, asset debited. Good. Next.
When buying an asset with credit. Okay, so once again, asset will increase. And it's creditor, so it's a loan. No, it's a creditor.
Yes, a creditor is the supplier. They would be
And
credited because it's a liability. Okay, going up, yes. Okay. Next.
when paying a liability, bank is always credited. Why? Okay. So bank will decrease.
Bank will decrease. Bank is an asset. Okay, you can't write liability. You need to identify what the liability is. Liability is the element. Lots of things are liabilities.
A creditor.
Yes. Okay, the creditor, which is a liability, is going to decrease or increase.
Decrease.
Debit or credit? Debit. Okay, good. Next.
Okay, so bank will increase.
Bank will increase. Why?
Because you're getting money from a debtor.
Correct. The debtor's
From a client.
paying you, so the debtor will be decreasing and the bank will be increasing. Yeah, debtors is the asset.
Yes.
Asset decrease on the credit. Okay, good. Right, next. Drawings are drawings.
So what? Bank. And
Bank and drawings. Okay, so bank is affected how?
it's decreasing.
Negatively, credit. Drawings? Drawings going up, debit, yes. Okay, good. Next, sales. Cash sales of 3 million. Bank is increasing. Okay, good.
And
Why did the bank increase?
it's a cash sale.
Correct. You made a sale. So sales is
Income.
correct. Not bad, eh? So you still have it.
Paying expenses.
Yeah, so what's happening here?
It's a telephone bill.
Mm.
You're paying with a check from the bank. So bank is decreasing.
Correct.
And expenses.
Not expenses. Remember, you get lots of expenses.
Oh, telephone.
Yes, you need to be specific so we know what the specific expense is. Okay, so just remember when you're looking at T account, you need to identify the actual account.
Okay.
Okay, next.
Income. Credit. Selling on credit. Okay. So
Yeah, debtors.
debt is increasing
Why?
because we're selling on credit.
Correct. So do you have debtors? No, you're creating them. Okay, remember debtors are created when you sell.
Yep.
And?
The sales.
Correct. Which is the income. And the income is going up or down?
Going up.
Correct. Okay. Okay, what happens here?
Okay. Buying on credit. Stationery bought on account. Stationery is a consumable.
Mm-hmm. Stationery, you said consumable. Is it a consumable? Yes, but it meets the definition of which account?
Of an expense.
Yes, okay, so that's better. Okay, so stationery is consumed, so it is seen as an expense.
Creditors.
Creditors is the liability, and if it's bought on account, the liability is going up. Good. Okay, so you've got it. Those are all the analysis. Now we need to look at process. Okay, obviously at a financial management, not financial management, financial accounting, FAC1502 level, you guys are going to be focusing on this. Lots and lots and lots of
Financial
disclosure.
statements.
Okay, so in 1501, you probably would have remembered you did quite a lot of journals in ledger, and the trial balance was something that you even had to draw up in one of the old past papers. In this module, you're actually going to be given the financial, the blank financial statement, the templates, and then you are going to have to create them based on the information given in the trial balance. Okay, so where are you starting? You'd be starting over here. That's where you'd be starting. in terms of this course. Okay, so in 1502, I'm starting at the trial balance and I'm trying to get to the statements. That's the main bit. Okay, so it's more adjustments and processing the actual statements rather than looking at the journals and the source documents and capturing it. Okay, so that's the one step further that this module goes. But obviously we've seen tier accounts before. Okay, you were looking at the analysis for the different tier accounts. Every tier account will have date, details, folio, amount. It's just the way we record the information, that's all.
Okay.
Where are balances recorded?
Balances are recorded on the positive side.
Always on the positive side. Because balances represent the account having something to start with. Right, so if bank has something to start with, bank will be debited or credited? Debited, okay, because then you've got something to start with. Right, doesn't matter what it is, even a liability. Okay, so I want to know what balances will these accounts have. What balances will they have? Debit or credit?
Okay, land and building is an asset, so it will have a debit.
Sales?
Sales is an income, so it will have a credit.
Bank overdraft? Think about it. You were showing your practice activities that you had to do. What is a bank overdraft?
It's an asset.
What is a bank overdraft? How would you describe it?
It's money that I'm basically owing to the bank.
Exactly.
Okay.
So what is it then?
It's a creditor.
Correct.
Stationery is an expense.
Good. So debit.
Yes.
Then
Loan from a bank
is
a liability.
So
Credit.
okay.
Debtor will be debited.
Why?
Because it's a debtor.
No, a debtor is
It's a client.
asset.
Asset.
Okay, that's why. Okay, so you first identify the element. Okay, vehicles.
Okay, vehicles is an asset.
Creditor.
Creditors is a liability.
Yes.
Credits.
Okay, and last one.
Interest income is an income.
So
Credits.
yes. Okay, so those are just balances. So remember, it doesn't matter what you've got. You need to identify what it is. Okay, because the question will start here. That's why this is important. Okay, because when you look at past papers will start with a trial balance and you'll be asked to post from the trial balance to the financial statements. Okay, so I see you printed out those copies. That's great because those statements we'll use later. The journals are only used in the bank recon and maybe if they ask you specifically for a journal, but it's not really tested that often. Again, remember the focus is more on financial statements, so debits and credits that are transferred through to the statement of financial position or statement of comprehensive income. Okay. Right, and that pretty much covers the rules in terms of application. Now we need to discuss some background info. So, what is a general ledger? Do you remember? What is it used for? What is its purpose? Why do we need it?
It's like an opsomming,
A summary?
summary of what happened in the accounts,
Which accounts?
in the business's accounts.
Correct. Okay, so do you agree the business is going to have lots of different types of assets? Am I going to put all the assets in one account?
No.
No, it wouldn't make any sense
Yeah.
because you need to identify the different assets. Okay, so what assets can we get? Just give me two.
Land and building.
That's one, land
Yeah.
and buildings.
Yes.
And?
And vehicles.
Okay, is a land
Furniture.
and building the same as a vehicle?
No.
Why not?
A land and building is not going to get you anywhere.
It's, yeah, correct. It's two completely different items.
Yeah.
So is it accurate to group them as one item? No. So we need to separate it and we need to show them separately. So the general ledger account, the GL account, is going to record individual accounts that follow a specific rule. Okay, so every account is going to have either a debit or a credit depending on what it is. Okay, so the account that's often spoken about is bank. What is bank?
Asset.
Correct. So it's one asset of many. Okay, because we get other assets like land and buildings, vehicles, and so on. Okay, so if I'm looking at the bank account, this account is going to record debits and credits. Okay, when I increase or when I decrease the bank. Okay. Right, so what do we or why do we have a trial balance? We saw it earlier. It's a list of accounts. You saw the example. Debits on the side, credits on that side. So why do we need it?
To see what's the income and the expenses.
No. Income and expenses are seen in the statement of profit and loss and other comprehensive income. What does the trial balance do? It checks what? Debits are equal to credits. Okay, remember the trial balance is just confirmation. It's to make sure that we can create an accurate set of financial statements, because the statements will be based on the balances in the trial balance. Okay, because the trial balance is a summary of all the accounts in one statement, if you will. Okay, but it's not really a statement, it's just a trial balance. Is that okay?
Yes.
Okay, so that's why we need it. It's checking debits equal credits. If our debits equal credits, we know we've done things correctly. Right, and you get different types of trial balances. Obviously, you are going to be given a pre-adjustment trial balance because you are going to have to adjust. Once you've adjusted, then you'll have a post-adjustment trial balance. So you'll have debits and credits for accounts that have been balanced off. Okay, or you'll have a trial balance where the accounts have been, or let's say the journals have been posted to the accounts and the accounts have been totaled up. Okay, so we've got the total, we've got the final balances in each of those accounts. Okay, so why is accounting important? What is its goal? Do you remember?
To give a summary of the income and the expenses.
And why do we need that summary?
To see if the money's making, or if the business is making money.
Okay, if the business is profitable, perhaps, or if the business is in a good or bad financial position. So do assets exceed liabilities or other reasons? Okay, so the key is decision making, creating value so we can have decisions or make decisions, and it's the information that we use in order to make decisions. Right, so we look at the financial statements, and then based on that we can either say this is a good product or this isn't a good product, or this is a good business or this isn't a good business. Okay, so it's always about decision making. And again, what is the focus? Disclosure. Do you remember what that means? Disclosure is presentation or layout. So what the actual statement looks like. So that's why I've put a reference here for either pages in the textbook or pages in your study guide, either or. Okay, so maybe just to turn to your study guide and just have a look at some of the example statements. That's all. Okay, remember it's format. It's how do these statements actually look like in terms of presentation of information. Okay, so the formula is OE equals capital plus minus profit loss minus drawings. You actually saw this earlier. It was on one of the separate slides. I just added it to this one as well, just to show the equity side of things, because equity is exactly what the owner is entitled to. Okay, meaning what the owner actually has in terms of worth in the business. Okay. Right, now we need to look at the next bit, which is your journals. How many journals did you print? Templates. Is it just one or two, or?
I've put everything.
Yeah, I know you printed everything, but how many?
5 of each.
Oh, 5 of each. Okay, nice. So you're just going to need one CRJ, one CPJ, because we're going to try record some. But you've already used the journals again before. Right, so again, basics, looking at journals. Right, so now you should be able to tell me, what is an accounting journal? I asked you at the beginning. Do you still remember?
What do you mean?
What is an accounting journal? How would you describe an accounting journal?
It's where every income and every expense are captured.
Yes. Okay, so you're capturing the income, expenses, capital drawings. You're capturing all the transactions. Do you agree?
Yes.
But do you record all the transactions in the same journal?
No.
No. So a journal does what? It groups the transactions. Do you agree?
Yes.
Okay, so it's the grouping that's important. And these are the different groups that you can get. Okay, so on the next page, you've got the journals that you could possibly have. Cash receipts, cash payments, purchases, purchase returns, sales, sales returns. Right, so what am I going to group in the cash receipts and payments? What is the focus going to be in those two journals?
Buying and selling.
Using what? Using? Cash.
Cash.
Cash. Okay, so bank will either go up or down. Purchases, what are you going to see there?
Money going out.
Purchases, well, not money going out, because you're not, if it's money going out, it'll be cash payments journal, right?
Oh yeah.
So not money going out. What's the group? What's the focus? That group is going to be looking at what? Debtors or creditors?
Creditors.
Correct. See, that's the focus. Right, so if I've got purchases, it doesn't matter if it's the purchase or if it's the purchaser's return, it's going to be a debit or credit. Well, either a credit if I buy or a debit if I return. But you're going to affect the creditors. That's the key. Okay, because remember you're grouping. Okay, so now what am I grouping in sales and sales returns?
Sales.
No?
Debtors.
Okay, yes, yeah. So the sales, which is your debtors. That's correct. Okay, so credit sales will be recorded in the sales journal. And the sales journal represents an increase in the sales. Okay, so just remember, journals are just boxes to group transactions. Okay, that's all it is. General journal, other adjustments. Okay, there's still one more there before you turn over. General journal. What is it for? Other. Okay, and we are going to be processing adjustments. Remember we spoke about prepaid, accrued, some of those?
Yeah.
We're going to see them again. Right, and you get lots of marks for recording those adjustments. Okay, because remember, what do you start with? You start with the trial balance, and then the trial balance is posted to the... Where does the trial balance get posted to? Or what is the trial balance used for? Creating a financial statement. Okay, because remember, what does the trial balance do? It checks that debits are equal to credits. And once you know the debits are equal to the credits, then can you draw up the statements? Yes, because then the statements will be accurate. Okay. Right, so let's see if you know what the effects are going to be for each of the different journals. Okay, so when you have one journal, there's going to be two things that are affected. Bank or creditors or debtors. So you've got those three groupings, okay, from here. Cash, creditors or debtors. And then it'll either be increase or decrease, depending. Right, so again, I've put chapter references here for the textbook and the study guide, just for examples. You'll actually draw up the journals, so we'll use those templates just to practice the recording. Okay, but before we get there, cash receipts journal, what accounts are going to be affected in that journal?
Bank.
And?
Income.
Yes. Okay, so it could be any income, or it could even be capital. Do you agree? Getting money from the owner.
Oh, yeah.
Alright, so you could have debit, bank, and credit, capital, potentially. Okay, payments.
Bank will be credited.
Good, because it's
You
decreasing.
paid.
Asset decreasing. Okay, so what I have there in brackets is the working. Remember, I always emphasize the working because that's the understanding. What did you write there? Asset. Okay, well, asset is one. What else could I pay for? What else could I pay for?
Like any expenses.
Correct. Yes. And maybe drawings. Do you agree? So I could pay for an expense, then I would debit the expense. I could pay for an asset, then I would debit the asset. I could pay for drawings, then I would debit the drawings. Okay, so it doesn't matter what I pay. Could I pay a liability?
Yes.
Yes, you could. So then you'll debit the liability. Okay, so you pay lots of different things. It all depends. But can you change the credit? No, you can't. If I have cash payments, bank will always decrease. Okay, cash receipts, bank will always increase.
Okay.
Makes sense?
Yep.
Alright, next two journals. Tell me what's happening here.
Okay, purchases, so it's money going out.
Okay, so if money's going up, no, you always say money going out. Why? Is cash being affected here? No, it's a purchase, right? So who did we say we need to focus on if it's a purchase?
Creditors.
Correct. So what's going to happen to the creditors?
Increase.
Creditors, yes, because are you going to owe more or less?
You're going to owe more.
Correct. Okay, so purchases will affect the creditors because the liability will increase. See, you got it. Now you've got the one half. What could I buy on credit? Okay, so you could pay for expenses on credit. So you could buy stationery on credit. Could you buy anything else on credit?
You could buy assets on credit.
You could. Okay, so inventory, vehicles, and so on. Agreed. Okay, or other. There could be other things that you could buy on credit that relates to loan or liability.
Okay.
Purchases, returns.
Okay, creditors will be debited.
Creditors will be debited. Why?
Because now you're giving it back.
Correct. So now, would you have a bigger or smaller liability?
Smaller.
Correct. And liabilities decrease where? Liabilities decrease where?
On the debit side.
Correct. And that's what you've got. Okay, so there you go, you've got it. Then whatever you return would then be credited. Okay, so you'd either credit the expense or credit the asset, depending. And then you've got PRJ or PJ, depending on which journal you've got. Is it the returns or is it the purchase? Okay, focus here.
Sales.
Good.
So it's a debtor.
Yes. Okay, remember debtors belong with the sales. You can only have a debtor if you have a credit sale. So now what's happening to it?
It's increasing.
Nice. If the debtors are going to increase, what are you going to credit?
Sales.
Sales, yes. Okay, so if I sell something, I'm going to have income, and that income is owed, so the business will have a debit and a credit for the income. Sales returns journal?
Okay, then debtors will be credited.
Debtors would be credited. Why?
Because they're returning whatever they bought.
Correct.
And then sales or income will be debited.
Sales or income will be debited. Correct. Okay, because you're reversing it out. Okay, good. Right, so that's the focus. Right, then you've got slides here relating to the general, which is other, and you've also got some notes about the discounts, okay, which we'll look at. Okay, so the first bit is general journal. Can any transaction be recorded in the general journal?
Yeah.
Yes, you can, because the general journal just has a debit and a credit. But we want to try group the other transactions into separate journals because it makes it easier for accounting. Okay, so if I'm looking at unusual transactions, what could that be? What would an unusual transaction be?
I don't know.
Something that's not cash, that's not creditors, and that's not debtors. Can't you think of one?
No.
Other. Do you remember depreciation? Sort of?
Yes, I do.
Okay, so now if you remember depreciation, how would you describe depreciation? Is it cash?
No, it's the worth of the laptop that's going
Correct.
down.
Exactly. So do you agree it's not cash? Is it credit? No. Is it debtors? No. Creditors? No. So do you agree it's none of those above, meaning it's general journal? Okay. Right, another one could be, let me just think, what else would you have covered before? We spoke about depreciation. Oh, let's talk about the adjustments. Prepaid expense. Cash? No. Credit?
No.
No. Prepaid expenses would be an adjustment, so it'll go to the general journal. Okay, so other accounting transactions go to the general journal. Right, last bit over here is just a note about the discounts. Okay, what I do want you to make a note of is what I've highlighted. Okay, but you've got the color coding. Okay, that's great. Okay, so obviously selling relates to who?
To
Debtors. That's key. Because you need to keep that relationship in your mind because we need to understand what's happening to the accounts. Okay, so the accounts here will either go up or down depending on whether we're selling or receiving. If I sell, debtors goes up. Okay, so if you've sold something on credit, do you always get the full amount? No. Sometimes you might offer a discount. So for example, 5%. So this means I'm trying to incentivize the outstanding debtors to pay. Okay, so does your company have lots of debtors that are outstanding? Or do all your debtors pay?
We only have like 2 that's outstanding.
That outstanding. Okay, so those are 2 debtors that still need to pay.
Yeah.
How could you incentivize them to pay? Maybe you give them a discount. So if they pay early, then we'll give them a discount to try and encourage them to rather pay early than to not pay at all.
Yes, we have that agreement with some of our suppliers.
Yes, okay. Well, when you say suppliers, that means you're paying them.
Yes.
See, that's a different discount. Okay, so here we're looking at the discount that you give your suppliers.
Yes, I know, but
Yes.
I just, yeah.
Okay, is that alright?
Yeah.
Okay, so you can mention what you mentioned here because now what discount do I have? Discount receive, because you're dealing with who? The creditors. Okay, so again the key is this: buying, creditors. Always, always, always. Remember, they're linked. When I have a debtor, I'm thinking credit sales. When I have a creditor, I'm thinking credit purchases. Okay, so a discount that's going to be received will arise when I do what?
When I pay early.
Exactly. Okay, when you pay your creditor early, they might give you a discount. And if that's the case, that'll be seen as income. Okay, so discount received income, discount allowed expense. Okay, there are 2 different discounts. Can I have a discount allowed for a creditor?
No.
No. Okay, because then that changes the relationship.
Yeah.
Discount allowed will only arise with the debtor. Discount received will only arise with the creditor. You could have one business that could be your debtor and your creditor if you're doing transactions in both directions. Okay, meaning you're selling to them, but you're also buying from them. Okay, that's possible. Does that exist in your business?
Yes, it is.
Okay, so there's a debtor that you sell to, and you're also buying from them.
Yes.
Okay, so then there you'll have two separate accounts, one for debtors, one for creditors, but it's the same business. Okay, and I think that was it. Oh, the last bit is just the VAT, and then we've covered this chapter. Do you remember your VAT? You should. Your VAT was pretty good when you did 1501.
Yeah, I think.
Okay, so you
I
describe.
think I'm still okay.
Okay, so you describe what's happening here. Why is this the summary that I need to take away? Okay, so we know what it is. So this summarizes almost everything.
Yeah.
So describe what you have here.
What do you mean?
What VAT do I have when I have a purchase?
Output VAT.
No, a purchase.
Oh, it's sorry.
Ooh.
Purchase is input VAT. Sorry.
Okay, alright, so notice the diagram gives you everything. Right, so see, this is what you should picture when you think VAT. Okay, picture the business, goods coming in or going out. Okay, so now we're applying it. If I have a credit purchase, will I have VAT?
Yes.
Which VAT?
Input VAT.
Correct. Okay, because you're purchasing, so the VAT is coming in the form of an asset because you get to claim it.
Yes.
Okay. If I'm selling goods, every good that I sell that has 14% VAT, are you entitled to it? No. Okay, so you guys are probably registered for VAT.
Yes.
Okay, so every time you sell something, there'll be 14%. Who do you pay that to?
Sorry.
Correct. So that's a liability. Okay, so output VAT is a liability because it's not yours, it's someone else's.
Okay.
And then we need to compare the two. So if the liability is bigger than the asset, will I have a refund or a liability?
Say again.
If the liability is bigger than the asset, meaning I've got more input than output, will I have a liability or a refund?
A liability.
Exactly. Okay, because that means you're going to pay SARS more than you've claimed. Okay. Businesses that have a refund will be businesses that have more input than output, and then you'll have a refund. Right, and those are normally like your fruit and vegetable type businesses, because fruit and vegetables are zero rated, meaning when you sell fruit and vegetables, you don't sell fruit and vegetables with 14% VAT. But are you still paying electricity? Yes. Are you still paying rent? Yes. Are you still paying stationery? Yes. And all of those things have VAT. So you can claim that VAT, but you just can't pay anything over to SARS. Okay, so those types of businesses will actually get a refund.
I thought it was like only bread.
Bread also, milk also, yeah. Basic food items. Basic food items. Okay, so yeah, fruit and vegetables don't have, well, let me say not all fruit and vegetables, obviously the most important ones, the basic, like, remember SARS has like a list, and on the list they have all the items that are zero rated, all the items that are exempt, all the items that are, well, they wouldn't specify the standard rated, because standard rated would be anything that isn't on those other two lists. Okay, so if an item is on the zero rated list, you don't pay any VAT. It's 0%. If something is on the exempt list, then you won't have any VAT at all. Okay, so it all depends. Yeah, but fruit and vegetables generally don't have VAT. So more often than not, I can't think of an item of fruit or vegetables that would have VAT. I would have to check like till slips the next time I buy
I'm
fruit and
actually going to
vegetables.
check my food and my...
Check it. You'll see a little asterisk or no asterisk. Okay, because remember they've got like a key. So the ones that are zero rated, there's normally like a symbol or something. Yeah. Maybe bring a sample. Bring your, well, it's month end, so you probably do grocery shopping, I guess.
Yeah.
So if you do, bring your till slip, and then we can actually see on the slip which ones have the VAT, which ones don't have the VAT.
Yeah, I'm going to
Okay.
do that.
Right, just as out of interest. Okay. Alright, and that's pretty much it for chapter 4 and 5. Now we need to practice.